Logic why I was trusting the fact that it was just a shallow run above that high is it did it and it rejected it. So that was good. It was occurring ahead of the 8:30 news release of the employment data. If it's going to fail to get to a level, and what level am I referring to? The new week opening gap high. So it failed to get there. So what is it telling me? It's telling me that when it broke below it ahead of time, it moved outside of it, saying, okay, any rally from here, if it rallies, it's going to be setting up a false run higher. That means faded. Treat it as a Judas swing. And where would the liquidity be? Be here and here. So what's going to have more liquidity above this swing high or this one? There's going to be more liquidity above this high, even though this is slightly higher, because there's more volume because of the bodies and how much time it's spent making that swing high. This high here was just one singular candle, right? And it's a wick. But this one here is a little bit more lengthy in terms of how long it took before it turned away and went the other direction. And the bodies are telling you what? The narrative. It's the storyline that's inside the bodies of the candles. Even though the damage is done by the wicks, this is telling you that the liquidity, the extreme, it would be above here. So you got to allow for that, right? But in here, the majority of the run for that liquidity is going to be to this high, which is why you see the bodies here being where they are and not needing to go above that high. This is a really good idea to look through your past back testing data when you're looking for relative equal highs. The easiest one to expect a run on liquidity, which one would you have your limit order on? Now, everybody wants to have a limit order sitting right there, right? Because it's in hindsight, it's perfect. You know, you want to use the best scenario when you're trying to learn, but that's not what you should be doing. You should not use the best case entry scenario. You should use the worst entry point, but still fit the criteria for your model. Using that as your back testing data, because you can form fit this stuff and torture the data, and you can have back tested data that is total bullshit, and you don't want to have that. You want to have data that's realistic. You're not going to get the highest tick, okay? You're not going to get the lowest tick. Try to get something in the middle or very, very close to the worst case scenario. And to be realistic and give yourself the highest form of reality, use the worst case fill for yourself, the least amount in terms of profitability and the worst entry point, but still meeting the criteria. Anything above this high here, okay? So what that would be is basically that high in one tick. That's where you would have your limit order to sell short at, not here. 15-minute time frame we're going to drop down into now. All right, and here is the high of that wick. Here's all those candlesticks creating that more meaningful, more prominent swing high where the liquidity is going to be larger here than it would be over here. A good exercise would be for you, like if you like to use those tools that retail traders lean on, which is like a book map, or if you like looking at level 2 data and you trust it. I don't trust it because it can be spoofed. Test this stuff when you're watching price real time, okay? See if there is not a larger pool of liquidity where there's a high that has bodies, whereas if you look at a high that's mainly predominantly created on the basis of a wick, there's not a whole lot of volume in that wick in relationship to what the volume would be in the swing high here. There's a whole lot more trades being booked here than there is on this one single candle inside that wick.